any second on your screen now. They'll just start coming up. Monday morning, we start a brand new week. It's a truncated week. Market breadth is looking decent. Coal India, Hero MotoCorp, SBI Life, NTPC. So it's not like a scary start, so to speak, despite the fact that globally things are looking slightly puffy-duffy. But you have to look at Adani group of stocks, Adani Enterprises, Adani Port, Adani Transmission, Adani Green. Adani Enterprises down 4%, Adani Ports down 3%. Will this gap down be bought into? Let's see. Adani Green 1% lower, and then you've got a smidge of red actually in other Adani group of stocks. So it's not like a scary sell-off, so to speak. If at all, it's a downward bias, and I think the downward bias is there on Nifty, the small cap index, and even the mid cap index.
Yes, up that 19,400 print, about a 0.5% dip there coming in for the Nifty. Let's see where it actually settles down. I don't think that opening move is quite settled just yet. There are, of course, a lot of earnings reactions. While Adani Ports is reacting to Deloitte resigning as their auditor. Remember, it's MSK and Associates, which is now the new auditor at Adani Ports. There's also ONGC, which came out with its numbers. The EBITDA has jumped up 49.5%. Margins have come in at 57.5% versus 45% on a sequential basis. 180 is where ONGC is currently in trade. The other blowout set of numbers, much unlike what you heard from the rest of the cap good names, was from ABB. It's a double-digit revenue and profitability growth across all segments in the second quarter. And surprise, surprise, ABB is actually down about 1.5% or so as we speak right now. There's Aurobindo as well. The US dollar revenue has come in above estimates. Revenues have come in at 10% on a year-on-year basis. Muthoot Finance as well. The AUM growth is at an 8-quarter high. The gold AUMs are higher by 17.6%. That stock lower by 5% as we speak. So it's pretty much a reversal of sorts. Good news is getting actually sold into this morning. Nykaa, let's check in on that. Overall, the numbers were a disappointment. The only sort of silver line to the cloud is that the margins have seen a bit of an uptick. They've come in at 5.25% versus 5.4%, and revenue has risen 9.25% on a sequential basis. But yeah, most brokerages have only downgraded the stock further, and the target prices have been cut further after the numbers. 4% of a gap down coming in for Nykaa as we speak right now. Lupin has US FDA. It's clear the company's Unit 2 manufacturing facility in Mandideep. So that's another stock which is in focus, marginally higher as we speak. But I'm struggling to actually find some green dots in the market right now. While, of course, last week was all about Z, underperformance from banks, one-odd moves like a Hindustan Copper, and not much is actually holding out in the green as we speak right now. A large part of the market across even the market breadth, that's down.
Okay, let's find out what Naresh quickly is punching in as his first trade and what he makes of the trade setup this truncated week and Monday morning at 19,300 levels. Naresh?
So looking at a bounce back on the Nifty from 19,300, which was the recent low. So 19,200 would be a stop loss. So that would be one. And second would be playing defensive. Power Grid looks like a good bet at current levels.
Okay. And Jay Kumar joins us. It's been a while we haven't spoken to him. So nice to have him back on the show and especially live in our studio. Good morning. Thank you for joining us.
Good morning.
It's been one of the strongest summer rallies of all time. We're calling it the summer rally of 2023. So do you think the summer rally will change? Has it, because the season has changed? Summer is over, monsoons have started. Actually, monsoon is getting over also now. What do you make of the market texture?
I think there's no question that money will keep coming in. The problem also is that there's enough and more in terms of supply of paper that's there, which is either in terms of promoters selling, blocks being transacted in the market, private equity funds getting exits. So I think there's a fair amount of supply of paper also. From that perspective, I think the index may well be, I would say, range bound in a 10% range. I would say 18.6, 18.7 on the low to about 20,200. Could be the 20,200, 20,000. We may, during the year, probably around Diwali, test that level. But I think we may find that we are expensive and therefore that range may continue to be that 8 to 10% range from 18.6, 18.7 to about 20,200.
Is the bias of the range up or down?
I think the bias needs to be towards stocks rather than towards the indices, because I don't think any individual investor actually captures the Nifty movements, just by investing in, let's say, ETFs or whatever. I think people invest in stocks, and I think the important thing is to identify where the sectoral biases are. So for a long time, tech and financials led the way. My own assessment is new rallies need to happen in, new sectors. So defense was one that played out. Could there be other themes? Pharma has been a theme that's taken off the last 1 quarter. I dare say it's not a 1 quarter theme. It's going to be there for multiple quarters. There are massive tailwinds in its favor. There's even a press note that talks about generics being prescribed or needed to be prescribed by doctors, etc. So essentially what you're seeing is here, new sectors come through, reasons follow. And I think pharma could well be that space because exposures are low, funds are not positioned towards it. Foreign funds are, very light on pharma at this point in time. So there could be, if people are focusing on export-led sectors, you could have a move out of tech into pharma continuing. I think it has already begun. Strangely, I think the well-integrated, consolidated metals and commodity players could also be in focus. I think especially the well-integrated steel sector could be like a new pharma in a mini sense, where the worst is taken care of. I mean, we had prices that went up to 85, 87,000 rupees a ton. And today they're at 57, but their margins are better at these levels because input prices have collapsed.
Yes.
And the government is not focused on prices now because from the end consumer point of view, he's not seeing 87 but 57. And yet companies are better off. I think here is where the China factor is actually playing in our favor, where the deflationary trends there means that the consumption of commodities, especially the inputs, are extremely muted, and that's what's poison for one is nectar for the other kind of thing. So really speaking, I think there are sectors emerging. You need to be sector focused. I think the Nifty is really a feel good kind of thing. I mean, if it's broadly in this range with a 19 prefix, I think people feel broadly good about it. Money will keep coming in, SIPs will come in. But the real story is identifying, I think, sectors that are early stage where every downside is factored in or discussed, and virtually everybody knows about China. I mean, you talk to people who, anyone on the street, they'll say, China's got a problem, age issues against them, consumption not taking place, etc. So what is the big offer, takeoff from there is this. I think Europe is still in some kind of a problem situation. But even there, for instance, the EMA has talked about increasing generics use rather than patented products to bring down costs for individuals. So I think if you see those, pharma and steel to me offer great scope in the next few quarters.
But when you say pharma, are you betting on an across-the-board move, or do you have to be selective when it comes to pharma?
I think
because each and every company has a different story.
I think it's principally led by the US markets, where again the move to generics is very clear. The FDA clearances have been much faster than before. Pricing pressures have eased. Shortages have existed. I mean, I've never in my life seen shortages in terms of the pharma except during COVID, etc. So I think
started again in US.
Started again in the US. The US markets, and as I said, the pricing pressures are making people move into generics in Europe. So if those two markets leading the way, in fact, strangely, the Indian markets have not shown, the domestic formulation business has not shown that kind of an offtake, but I think it could follow. So pharma from an international perspective, so those who are generics, export oriented, they could be it. There's an interesting play. Some of the companies here, and I don't talk stocks, so I'm kind of referring to them, alluding to them, if you will, that which have PLI built in. Where the PLI essentially allows you to become more domestically, independent of international critical inputs, whether API or intermediates. And from that perspective, one or two companies that are in the PLI space could stand to make serious money over the next few years because there are government incentives in addition to getting independence on the, being independent and integrated on the input front. So I think to me, pharma is a sector and a few stocks within. Steel, again, well consolidated, the top 2, 3, low on leverage, that's the way forward. So you're low on leverage, you're expanding through internal accruals. Your margins are expanding at these levels. The government is not putting pressure. And, overall, so these are two big sectoral plays that we are focusing on at this point in time.
Jix, but, the whole appeal that Indian pharma companies have got a huge generic case is almost like a 10-year story. We've seen so much of cyclicality played within that it absolutely amazes me. There was a time when Lupin had margins of 25%. Now the margins 2 quarters ago, they plummeted to 7-8%. Ditto for Aurobindo Pharma, ditto even for Glenmark. It's getting hard and hard to decipher that whole picture now.
Well, if it was easy, we would not be investing. So
that's why we have you.
No, I think the thing to see here is that generics as a theme may have had its second coming in a sense, because today I think approvals are becoming a lot more, sort of Indian companies are getting a lot more focused on compliance and approvals than ever before. So a lot of investment has gone into that. Number two, approvals, as you see recently, are also more forthcoming, which therefore we become a need of that market, not the other way around. If you see the commentary of various things, they talk about pricing pressures easing off. So while you're right about the cyclicality of it, I think the problem also has been that these the pharma stocks have been are trading at multi-year lows if you take a quarter ago in terms of multiples. So from that point of view, they offer a lot more. So the worst was kind of factored in. And in the markets, remember one thing, when the worst is factored in and there's no limited downside, then effectively only upsides emerge. And the reasons follow later. It's true for steel. I see it being true for pharma in the same sense.
Why steel? I mean, is it because of China or is it
because I think a year before elections to 2 years after elections is the highest amount of capex. That is a capex-led economy for the moment. That's number one. Number two, post high interest rates in the world, whether you take World War I, World War II, when interest rates spiked up, post that the greatest amount of thrust any government gives is on infrastructure and real assets. So that's going to be the way forward. So when you can't, and especially with the kind of layoffs that there are in the on the tech front, courtesy everything from AI and other tools, I think governments world over will go back to the age-old. I would not say do what the Chinese did, which is break bridges to remake bridges for GDP, but essentially that kind of a thing, which means if you see now, a lot of travelers into the US will talk about airports taking on a much better look there and looking almost as good as Indian airports, quote unquote. That's true for a lot of the highways, roads, pipes, I mean, I can just name industry after industry which needs revamping in the US. They talked about a $2 trillion infra package. I'm not sure how far that's gone down the path, given their own issues. But I think the way forward will have to be infra and will have to be, so I think steel is a beneficiary there. Prices have come down, but margins have improved. I think that's the big take.
You alluded to defense as a sector also earlier. Is the meaty rally over there, or do you think there's still to go?
I think it's substantially over.
Substantially over.
So when people start focusing on, when fund houses start launching defense-specific funds, you know that the rally is pretty much over for now. And then there's organic growth. So it could come from many spaces. And also remember, like infra, like capex related, cap goods related, you have defense also as a pre-election build-up.
Yeah.
And that's kind of played out.
What's the outlook?
Short-lived, one must say, right? Barely a year and a half.
To be frank, Mazgaon Shipyard and some of these companies, they actually always existed. They were always in defense. It's just that post-COVID, when you started ring fencing the entire sector, you gave Indian defense companies PLI benefits, the private guys came in. You made it mandatory to outsource from local, which is the word Indianization. And I think there was an import ban on more than 100. We are remembering Rakesh Jinwala today, first death anniversary. And I remember, Jakes, a chat I had with Rakesh Jinwala in 2014, and he said that India, the next big boom in defense is coming. I mean, his vision to see what could be called as a trend 3, 4, 5 years ahead of that actual occurrence was extraordinary. We all miss him.
No question about it. I mean, very, very dear friend, and it's a kind of a humbling moment to sort of just look back and talk about him in the past tense effectively. I mean, he's been a good friend of a lot of channels, you personally, and certainly a very dear friend of mine. So we continue to miss him on a regular basis, not just today as it were, because that whether it's a call at 8 o'clock to say, what are you doing, let's sit and chat, and a 10-minute chat becomes a 4-hour chat, or
it will start from 9 point and end at Jeffries, right?
Well,
Back in the day.
considering I'm a teetotaler, it kind of, for me it was slightly.
Ended there.
We were also neighbors, so it usually.
Oh yes, you shared the house.
Yeah.
the old
So we
house.
were actually, we used to meet up pretty often, late evening. But yeah, sure. I think you remember legends, and you remember. I think it's one of a kind. I mean, you will stretch hard to, rediscover another Rakesh Jhunjhunwala in our midst, as it were. So.
Yeah, and leaving behind a wonderful legacy at that. What about your outlook, Jakes, when it comes to the broader markets? You're talking about a range for the index, but do you think that it's going to get a bit frothy when it comes to mid and small caps?
I think it's already frothy there. I think if you see the kind of, mad scramble in stocks and this entire ESM framework which, SEBI has imposed with modifications, most of the modifications nobody understands, but that apart, I think it's, other than restricting trading, if you will, that clearly is an indication of prices that have gone, that go crazy. So in every market you will see this, and because people are feeling left out, they haven't come into the frontliners. So paradoxically, I think there's safety in the frontliners as compared to some of the small and mid caps.
Jakes, is there a genuine case now to revisit consumer tech and fintech stocks because the business have survived, free funding is over, and the promoters have realized that look, they are no longer in the IPO, in the PE market, they are in an auction market where they would be judged on a daily basis. So that late realization, I think, is become the new truism for them.
Well, I mean, if you're talking about the new age companies specifically, I think, when headlines hit you, it says that after 15 years, one company XYZ makes a profit for the first time. You just realize the amount of money that has backed them. And they have been, in a sense, pampered by. So, in a cement case, for instance, you have a capex defined upfront, and maybe some capex before you break. I mean, and some sort of burn, if you will, before you break even. Here, the capex is defined as the amount of funding that goes on and on before you finally have a quote-unquote profitable model. I mean, profit was meant to be the first objective, not funding. But so I think the way we assess these has changed. I still think many of them are quoting on the severely on the right side of excessive. So they are still excessive, no question. I mean, many of these companies which listed in the last 2 years have market caps of 40,000, 60,000, 80,000 crores.
Zomato is nearing 1 lakh.
Well,
Policy Bazaar is 40-45,000.
Well, and the others which we...
Paytm.
So these are not cheap by any stretch. I mean, not to forget, many of the companies in the Tata Group have taken 150 years to get a sustainable 1 lakh crore market cap. So you do wonder whether, and especially given the overbearing nature of tech that is involved, that what can disrupt some of these things. Of course, it's true that some of these have become habit formation. We order our food, we order our cosmetics, we order our various things, pretty much online. Are we willing to pay excessive amounts which are left behind as margins for these companies? I'm not so sure. So I think you will come to a situation where some of these companies will hit the market for new rounds of funding, as is happening in the case of PharmEasy and others which we hear about, right? Where they are going in for new funding. And funding is, again, an important pointer here. In a listed company, when you need funding, you go for a rights issue, supposing, and you go at a discount to market to price it to sell. The unlisted scenario is the only aberration in the world where you price it higher than the previous round, as though that's God ordained, right? And that 4 out of the 5 investors put in new money, and they wait for the one bakra to come in and sort of make up the ratify, saying the outside investors also put in. So I think all that's going to change. So people, and like PharmEasy has realized that whatever price you're able to raise money, please raise, because survival is the most important metric right now. We'll talk valuations later. So I think some of these new age companies will be seeking new funding. And to my mind, that's when they start getting derated, because you've got to price it then to sell, not price it from a valuation perspective, which many of these investors still have, some of the age-old investors still there. That's why you hear Paytm, some of the Ant Financials and others selling out. Of course, it still amazes me that some of these promoters, like we heard about a recent deal, will actually buy out some of these people in deals offshore or onshore. I mean, if ludicrousness had an extent to go before, I think this kind of scales way beyond all that.
I mean, Paytm is right hand moving it, giving you to left hand. As simple as that.
But hasn't a lot of the derating has already happened, right? How much more will they fall?
If derating has happened at 50,000 crores, there are 4 zeros after a 5. After a 5. So, let me not say where the derating stops. As again, to quote Rakesh Jhunjhunwala on a day like this, in a bull market, don't seek the top. When derating, i.e. a bear market, don't seek the bottom.
So what is the top for this market?
We don't seek it because I think it's a bull market.
It's a bull market.
But if in individual stocks corrections continue to happen while the markets move up, sure they can.
What is the importance of the next year's election cycle? Today we are not talking about it. But 6 months from now, 1st of January 2024, everybody will talk about it.
Sure.
So for a long-term portfolio investor, when you know that election cycles in India historically, unlike a lot of other countries, they have played an important role. A 5 to 15% swing is something which is considered to be par for course. What happens to that setup?
I'm not making predictions, but I think over a period of time, we started saying budgets don't matter. Through elections, I think we've realized long-term portfolios don't matter. But a positioning for the short term, can there be a black swan event, etc.? By definition, if you can predict it, it's not a black swan event.
Yeah.
So you hope that continuity continues. I mean, that's the only thing. I mean, this is one where I feel a change will not be seen positively. I think we'll need continuity. Numbers can vary. Some may even argue that a coalition with moderated numbers may be a better thing. I'm not a political pundit. All I know is that many of these don't stand the test, way beyond, let's say, a couple of weeks. People tend to forget and move on. But unless something, God forbid, drastic were to happen, I think it'll come and go. That too will pass. But there could be tactical plays which many of the day traders and week traders are significantly more equipped to talk about than I am. And that will continue. But I think the elections are a bigger thing than most budgets. And I think we should be clear that while policies may not change, but it could be sentiment negative if something untoward were to.
Absolutely. Jake's always a pleasure speaking with you.
Thank you.
Thank you so much for taking the time out.
Wish everyone the very, very best.
Yes.
Thank you very much.
Thank you so much. Oh, by the way, we're down a good 165 points actually. So you're almost headed in for that 1% cut. And I'm just looking at the futures picture. So we're just about clinging on to that 19,300 print right now. Sub that level for the Nifty spot. 155 points lower as we speak. It's the Adani group of names, of course, which are weighing heavy. So Adani Enterprises, Adani Ports is now down 3%, by the way. Tata Motors is down 3%. There's Apollo Hospitals. SBI is down 2.25%. There's Eicher, Bajaj Finance, Britannia, M&M down 1.25%. And even within the liquid universe, wherein the breadth 2 of the market has gotten challenged today, there's a Muthoot Finance, which is down nearly 8%. ABB, irrespective of good numbers, the stock is down 5%. Yeah, go ahead.
No, Aisha, you're going through that phase of the market where rarely, but good news is getting ignored.
Yeah.
Markets are saying, okay, we knew this was coming. Nykaa, well, why the stock has fallen down? It is a clear example of how perception has changed for Nykaa. When Nykaa went public, it was like the only crazy talk of the town. It was a cash flow positive company. They had a marginal profit, but they had a profit nevertheless. It got a premium, massive premium. But Nykaa has only got hit because of intense competition. The whole bonus issue, the way it was handled, it has left a lot of bitter aftertaste for long-term investors. And competition, in a sense, is now visible when it comes to their various business lines. I think it's visible.
Yeah, 8.25%, no less. That's the move coming in on Nykaa. ABB, like Nikunj said, good news in this market is getting completely ignored. Although on the other hand, Jakes was just talking about pharmaceuticals. It's actually pharma which is holding out. So Lupin, after getting that US FDA nod for their Mandideep facility, Biocon holding up 1.25% right now, 1.5% actually. And PVR Inox is sitting on top with a 1.6% gain. ONGC up 0.5% after its numbers. We will, of course, now be chatting some more earnings. We have with us Sunita Reddy, the MD at Apollo Hospitals, joining in on the show. Would like to know how their earnings have panned out and what their quarterly performance has been. Remember, this has really been a darling of the markets as well, Apollo Hospitals, with a revenue uptick of 16.5%, although profit downtick. Let's try and understand which way the mood for Apollo Hospitals is headed. Sunita, great to have you on the show. I'm just looking at your ARPOB, which has seen a healthy jump, in the first quarter. What's not translated fully to EBITDA margins, though. So, a two-part question, really. First, tell us what's led to the growth, and secondly, why the slip in margins?
So, the ARPOB has grown by 11%. To 57,340. This is due to a shift in our payer mix, which has been increasingly healthy. Currently, there has been a 10% growth in volumes, but in the payer mix of insurance and retail now comprises 80% of our business, and we have seen 20% growth in this payer mix, and this is really what has contributed to our ARPOB. Beyond that, if you look at case mix, we have now 63% of our work coming from the Congo specialties, surgical work, which is coming from the Congo specialties, which is cardiac, onco, neuro, a lot of surgical work, which has led in part to the drop of 30 basis points in EBITDA margin. So going forward, I think we have absorbed the costs of the new doctors and new surgeons that we've onboarded. In fact, we've onboarded 100 of them. So we have absorbed the costs, and I think with increasing asset utilization, volume, and revenue, we should be able to cover this, and margins will improve.
Overall occupancy across the group was at 62%. While you guided to a 70% mark, will you continue to stick to that, and would you get close to that number?
So what will get us close is, I think the first quarter was a very challenging quarter in terms of, being a holiday season. I think that number one, but also travel was very restricted to the entire Chennai cluster because of rail and air issues. And I think it was partially muted because of that. Plus this whole thing of holidays and people going on leave. But going forward, we're seeing a very healthy July. So I'm optimistic that we should touch around 67 to 68%.
So you're saying that you're reducing the 70% guidance now. Could we assume that it'll be around 67, 68% then?
No, we're getting close to 70. I think, we have internal targets of 70, but I'm quite sure we will definitely be in that region of 70.
Right. So I want to talk about your healthcare platform as well, right? HealthCo. You guided for about 45 to 50 odd crore rupees reduction in costs in the first half. The PAT break even in the fourth quarter. How close are we to achieving these targets?
So there was a 6 crore reduction in cost. I think more importantly, what they've done is to reduce the discount. So that has worked out very well, because if you look at the EBITDA, it was just negative by 53 crores versus 72 crores in the trailing quarter. So they are bringing it down, and in the fourth quarter, they will be EBITDA neutral, which I think, for any omni-channel, this is definitely the fastest growing, which will be EBITDA neutral in this third year.
Can we see pharmacy segment and how can we see the pharmacy segment grow in Q2, and what are the plans on investment and store expansion there?
I think we did a huge addition last year where we added 1,000 pharmacies. We will add about 400 pharmacies this year. And what we will see is the revenue and EBITDA coming from the offline stores because of the pharmacy addition. So currently, revenues in Apollo HealthCo grew by a healthy 22%. And this trend will continue and accelerate because of the investment that we made last year in pharmacies.
Right, and you say that this quarter you've taken a judicious decision to lower your discounts in pharmacy. Will you stick to this going ahead as well? And how are you looking at the GMV levels?
So certainly, you will see that there will not be deep discounting. The team will look at market and they will be very rational. They'll be very careful on how they plan discounts. But GMV of 3,000 crores is something that we're on target for.
Right. Any update on the plans regarding the fundraise in HealthCo? By when can we see this happening?
Like I said earlier, there was absolutely no urgency. Considering the state of the markets and the valuation we deserve, I think there was a time to be cautious about taking in new money. But we do have access to external capital, and maybe in the third quarter, if required, you will see some transaction.
There has been a drop in EBITDA of Apollo Health and Lifestyle. Can you help us understand that why that has happened and how can we expect the margin profile going forward?
So the good thing about Apollo Health and Lifestyle is that diagnostics is on track for 100 crores per quarter with a good 10 to 15% margin. The drop in EBITDA and in profit is a one-time because of, it's a one-time cost. And I think next quarter they're on track for much better performance.
And the growth in your international revenues, what is the kind of growth that you're expecting from the current levels?
Currently, it's at 5%, moving to 8% by the end of the year.
Okay, great to have you today on the show, Sunita. Thanks for highlighting how the earnings have been. Just look out for what the market is up to because we've plunged further from that opening gap down of about 0.5% or so. Almost a 1% cut is what you're seeing on the index right now. We've even breached that 19,300 print and just a smidge of a recovery coming in from there. It's the Adani group of names, Tata Motors, SBI, Tata Steel, Eicher, Bajaj Finance, M&M. They are the ones which are weighing most heavy on the indexes. And by the way, all sectoral indexes are in the red as we speak right now. But still in the thick of earnings, and let's talk about Bikaji Foods. They've actually seen the highest palm oil prices in the quarter gone by, and on a year-on-year basis, of course, there's been a fall. So let's try and understand, how these nitty-gritties actually play out for Bikaji Foods. We have with us Manoj Verma, the CEO, and Rishabh Jain, the CFO, joining in on the show right now. Manoj, Rishabh, both of you, thank you so much for taking the time out and joining in. Manoj, if I could, kickstart the discussion with you. For the first quarter, help me understand what was the big picture like with what was happening with palm oil prices and how volumes as well as prices for you panned out.
Yeah, good morning and thank you. So first quarter in terms of our bottom line has been, the continued numbers what we have been delivering not only in this quarter, in fact, for last 3-4 quarters if you look at it. So it's been really good in terms of bottom line. Talking about the top line, this quarter, after many quarters, this industry, this category has witnessed growth led by volumes. So we have grown at 15.2% in terms of volume and a value growth of 15%. So that's the delivery what we have seen. And this is, if you look at growth over last quarter in YOY over last year. So EBITDA is gone, far beyond what we thought for also.
I think we'll get you back again. I think, there is a bit of a technical problem there, Manoj and Rishabh. We'll just, get you right back up. Bikaji Foods, for the quarter gone by, it's been a very interesting one for commodity consumers. Pharma companies, tire companies, paint companies, because commodity prices had declined. When we are looking at numbers for the quarter gone by, remember we are talking about June, July. That we are talking about April, May, June. We are in August, and post that it's only commodity inflation which has made a comeback. So Rishabh, while we are talking about numbers for the quarter gone by, where palm oil prices had come down, transportation cost had come down, grain prices had come down, now it's different. Tomatoes are expensive, potatoes are expensive, प्याज महंगा हो गया है, everything is gone up.
No, true. So, yeah, in last 1.5 months, we've seen again showing some inflation in key commodities. But yeah, we have done some smart thing. We have done some smart booking of long-term booking of key raw materials, which will have negligible impact on our overall costs. So that's what we have done in early when the crop time was there. So that's what our strategy was. But of course, yeah, in last 1.5 months, we've seen good inflation rising back again.
Rishabh, for the quarter gone by, your volumes were at 15% because you continue to guide at 20%. What you're reporting is 15%.
Right.
So are you in for a big quarter? Do you think that this time around Diwali, Dashera, more farsan would be sold?
So basically, you will see in last 5, 6, 7 years, we have been growing at 13 to 15% volume growth versus 21% value growth. This quarter, we had done highest volume growth of 15.5%. That's what volume growth we have done. But yeah, of course, the price growth was negligible, and that's what we're seeing in numbers. So our value growth is also 15%. But overall, at the year end, what we are targeting and looking at that we should be above 15-16% volume growth. Of course, price growth, we'll see how it goes for, how the commodity price go for. But yeah, the volume growth what we are targeting is above 15-16%.
Rishabh, I always look at one number to understand which way company is moving, and that is return on capital employed.
Right.
Where do you see your return on capital employed? I mean, Manoj, Rishabh, anybody can answer that. Where do you see your return on capital employed as the entire volatility of the commodity pricing settles down?
Right. So you will see currently we are at capex expansion cycle, right? So we have done major expansion in the last 1.5 years. By end of FY24, we'll complete our capex cycle, and we are investing close to 440 crore rupees in our capex, what we have started in 21. So of course we got PLI benefit for the same, and we've completed our capex cycle. Currently our asset turnover ratio is close to 40 to 43%. And we're targeting to taking to 75-80% in next 3.5-4 years. So that's what target we are taking in, and we will be at par with the top FMCG companies. What they have ROC. We also want to be 35-40% type of ROC, and we are gunning for the same.
Manoj, morning. What is the outlook when it comes to the competitive intensity as well? Because it's not just the unorganized sectors. You have a lot of niche brands as well that are coming up with, these sort of healthy snacking options, etc. So what's the USP? What's the game plan to take on competition? How are you dealing with that and growing your market share?
So certainly competition is pretty intense. So what we are doing, I'm sure our competitors are also doing the same. So how we're trying to be, ahead of curve is our focus on distribution. That's one. Second is our continued focus on our marketing investment. That's number two. And third is about, improving our efficiency, sales efficiencies. These are three key vectors which our teams are working on and are giving back pretty good dividends.
Okay, fair enough. What about the benefits that you're looking to reap from the PLI scheme? You got the first tranche of close to 20 crore rupees, if I'm not mistaken, in the month of March. How much will you be getting for FY24?
So basically, at overall level, we got close to 261 crore rupees, which we'll get in next 6 years. So first tranche was 20 crore, which we received in March 23. This year, so there are some filing which are going on. So we're targeting to have second tranche of from government, which is close to 30 crore rupees.
Manoj, what will be the total net capacity addition? Because you are in the middle of a capex cycle, like Rishabh said, I'm aware of it. By FY24, what will be the capacity addition on stream?
So the capacity, most of it we have already done. It's one plant which is to come in Bikaner. This is a frozen plant which will come by end of this calendar year. And another plant which is coming up at Raipur in Chhattisgarh. These are two more plants. That's what would be the final stuff, which would be around 9,000 metric tons per annum capacity. That's what we'll add more.
And out of this 9,000 metric ton, how much do you think would be would in a sense be captured in FY24 is what I'm trying to understand, because the volume growth number what you're giving, does that include the upside which will come from the from the new capex addition?
See, what we are talking is that what all will be our investment, and this is basically a prerequisite of getting PLI incentive, is to complete this by FY24. So everything will come within this year. However, we are in an expansion mode, so the utilization would come, over years kind of a stuff. That's what will work like.
Sure. Manoj, Rishabh, both of you, thank you so much for taking the time out and joining in today on the show. Good speaking with you today on ET Now. Let's just revisit what the market has settled in at. A minute bit of bounce, but let's see whether this sustains or not. Actually, no. We're back to those sub 19,300 levels. Saw a smidge of a recovery play out, but pretty much getting back to square one. In fact, let's bring on board Naresh as well as Kunal as well and try and understand what they're making of the market moves right now. Naresh, let's first start off with your chartbuster idea.
So looking at a small cap NCL Industries now, the stock has gone through a sideways consolidation for almost a year and a half. In that period, we saw disclosures and where promoters have been buying all through this period of 1 to 2 years. They've increased stake. Finally, post results, the stock saw a breakout move. The volumes were almost 5x plus on a delivery basis. So that's a big indication of a breakout, large breakout with large volumes. Expecting this to see a move towards 260 to 300 eventually, and accumulated current levels of 210 to 230, stop loss at 200.
All right, let's get in your take, Kunal.
Well, the charts which I have showcased today is on the rupee chart, because it's ending, or it's about to end at 12 or 10 or 11 month of consolidation. This was the last time in October 2022 that rupee was almost at that 83 mark. From there, as you can see, there have been multiple attempts for the rupee to try and come closer to that 83 levels. In every sell-off or in every correction which happened post that, the rupee made a higher low in that sense. So this was the low, which is closer to 81.25 for rupee. This was around 81.5. The recent low was around 81.75 for the rupee, and now the rupee is coming back towards breaking that 83 mark. So this could be what we call it as a classical ascending triangular pattern for rupee. And if the breakdown happens, which means in this case 83 gets taken out, then we could be looking at a depreciation of at least another 1.5 rupee for the currency, which means closer to 84.5 is where we can expect the near-term target if this breakout sustains above the 83 levels.
All right, let's get those individual stock recommendations going as well. And Naresh, what's on your radar today?
Focusing on oil and gas, ONGC, and the numbers are out. The stock has come very close to that 180 mark even today. Expecting this to break out over the next few sessions. Stop loss at 175, target price of 200. Second is a buy on Reliance Industry, showing strength today, as well as crossing a 10 to 12 day high. Stop loss at 2500, target price of 2650.
What about your stock specific ideas?
So two buy calls. J&K Bank is the first stock which I would suggest as a buy. Again, focusing on those mid-cap names, and the stock has been doing reasonably well. 85 as a target, stop loss to be kept at 75. And PFC, Power Finance, another PSU which is looking attractive. Stock crossing above that 250 plus mark comfortably. So buy with a target of 278, stop loss at 259.
Okay, let's move on. Let's talk more earnings. We have with us Rajesh Prasad, Director Finance at RVNL, joining in on the show right now. Rajesh, great to have you today on ET Now. Thanks for taking the time out. Just wanted to understand how the quarter gone by was, because from what we understand is, while it was steady on a yearly basis, a little soft on a sequential basis, quarter on quarter that is. Tell me, what are the revenue as well as margin targets that you may have set out for the full year?
Okay, so very good morning to all of you. Thank you. I'll make a small correction. I'm Director Operations. Director Finance is having some engagement, so he is not here today. Anyway, so the question which you have asked about the quarter and then the whole year's performance and the future way forward. So last year in FY 22-23, if you recall, for the first time we crossed the turnover of the top line of 20,000 crores. The bottom line was also all-time high. The commissioning was also all-time high. And this quarter, this Q1, if you recall, we had a turnover of more than 5,400 crores, an increase of around 17%. And the bottom line also increased by 18%. What I wanted to tell you is that in Q1, this is the all-time high. This Q1 of RVNL. This is all-time high. So whatever we have been doing, we are moving forward. We are getting a lot of success. And regarding this FY 23-24, the top line would be around 21,000 plus. The bottom line last financial year, we had around 1270 CR. This year, we will definitely cross the 1400 crore mark. And see, this is a government company. We have molded ourselves into the business development and taking the projects from the market. A lot of challenges were there. And the margin which you have asked, this quarter, we had the turnover, the margin upon turnover was around 5.92%. It is again one of the highest. And in time to come, since we are going in the bidding system and we are taking a lot of markets, and with the way we have been working and the kind of efficiencies we are having, we are 100% sure that the margin is likely to improve.
Okay. Why do you think margins will improve? Because it is not that the private sector business will come at a very high margin. If anything is coming through competitive bidding, it's not going to be like a 30% margin or 40% margin.
I'm not saying 30% or 40% margin. Nikunji, you please kindly appreciate few things. In RVNL model, we have got the margins on the projects which we have got on the nomination basis, number one. We have got some balances in the banks, so we get the interest. We are executing some deposit works, so we get the money in advance. We are getting the dividends from the SPVs. We have commissioned 5 number of special purpose vehicles, and these 5 number of special purpose vehicles have generated revenue to the extent of 1 lakh crore to the Ministry of Railways. So what I want to tell you is that these are the models, and since we are in the market, and the kind of efficiency we are very new in this particular field. We got the first project in the month of November 2021. So it is not even 2 years. And we have already bagged more than 30,000 crores of projects from the market. We have a lot of plans to further enlarge and enhance the efficiency of this bidding cell. We have got the business development cell, design cell, legal cell. We have already opened the procurement cell. So what I wanted to tell you is that when you bring the efficiency in the system, the value addition, value engineering, then automatically these factors take into the factors, and the margin improves. And we don't eye the margins of 30%, 40%. What we want to have is that we should have the sufficient orders, number one. We should have the bottom line growing with the same kind of percentages. The investors are also very keen for the bottom line. And see, the infrastructure creation is also linked to so many other factors. We are a government sector where the government is having a share of 72.84%. The infrastructure creation is linked to the social justice, social requirements, ease of living, then ease of business. Then it is required for the overall growth of the economy and the country. So for a public sector, we are not considering margin which are in terms of the numbers, but also in terms of other intangible factors which I have just now said.
That when it comes to your overall margin picture, you have been as well at the receiving end of a number of orders, the Chennai Metro Rail, etc. When will revenue from this kick in? What is your total order book position right now, and how do you plan to grow it?
So, madam, see, as on date, the order book is around 65,000 crores plus. Out of that, 35,000 crores is through the nomination basis, and 30,000 crores through the bidding. Sorry, we have participated in bids to the extent of around 175 numbers, approximately 95,000 to 1 lakh crores. We have got the orders worth 30,000 crores. So the strike rate is, some of the bids are yet to be finalized. So the strike rate is more than 30%. And our basically focused areas is the railway infrastructures, the metro segments, and turnkey projects. And for the foreign projects, the neighboring countries like Bangladesh, Sri Lanka, Maldives, Mauritius, African continents, where we have got the assured funding of LOC, World Bank, ADB, JICA, and African, some other AFDB. So what I want to tell you is that we have got a lot of plans for expanding our business, and we have got plenty of works. Now you asked about the Chennai Metro. We have got 4 packages of Chennai Metro. The elevated metro corridor is on track. We have already established the casting yard. The piling activities have started. The casting yard is almost ready. Then the underground metro projects, recently we have got 3 packages. A lot of challenges are there. So your question is about when are we going to get this revenue out of these projects. In FY 23-24, we will have the revenue. What exactly will be the revenue, that we have already worked out. We have got a plan for that, but the revenue will definitely get reflected in FY 23-24.
Time. Thank you for joining us. 3 hours from now, 3.5 hours from now. Well, ET Now Freedom Special. What is freedom? Well, you know, in ET Now we've always advocated a simple concept: financial freedom. The path of financial freedom is something which the sooner you start, the better it is. Power of compounding. Let the magic work for you. We always tend to time markets, but don't time your markets, time your goals. And if Einstein can say that the 8th wonder of the world is actually power of compounding, then how can you really apply that in your real life? Power of compounding. We tend to think that, okay, power of compounding is only in financial market, but you try and apply that in your real life. And if you work slowly, gradually, with discipline, I guess magic actually can happen. You know, we are so accustomed to look at power of compounding, Aisha, in financial markets. I'm trying to apply that in my real life. And it works both ways.
Yeah, absolutely.
I mean, on bad habits also, it can backfire.
Yeah.
I mean, it's like saying that when somebody gets an addict, before you become an addict, to actually start small. Yeah. And just that the power of compounding works against you, and then you end up, you know, within bad habits. So power of compounding, financial freedom, very basics. You know, someone asked me that, you know, what is the definition of financial freedom for you? And I said, look, for me, I look at life very differently. Something which I've learned over the years. I'm sharing with you. And with everybody here, and with you also, Kunal. What is the most valuable commodity in life? It's time. The time you have is the life you have. So ultimately, how can, and that's what I'm looking at working towards, how can I get financial freedom of my time? How the compulsions of life, how compulsions of life can actually be measured with wealth, and how can I get financial freedom of time? I can meet whom I want to meet, I can spend time the way I want to spend. So that is a goal, if you frankly ask me, I'm working towards. Financial freedom, and for me that is the meaning of control over time.
Is it timed, the goal?
I don't know. You're working towards it. You're working towards it. But I'm saying that ultimately, I look at it this way, that we tend to think that money and wealth is the most important commodity in life. No, it's not. Not for me at least. That's what I've realized. I think it's
the
time.
freedom of time,
Time. How can you get
if
time?
You've accumulated enough wealth, you're not you know, dependent on an income, and then you use your time the way you want.
So if you plan your life, that's what I want to do, and that's what I think we'll talk about today, the importance of financial freedom. For some it is time, for some it is wealth, for some it is income, and for some it is health. But it's freedom, which is what we all aim for.
Yeah, absolutely. And you can catch this 1 hour on the wheel special of ours at 1:30 p.m. today. Find out how is it that you can gain financial independence. We're going to be joined by a whole host of experts throughout this 1 hour wheel, wherein we're going to dissect all the means and mediums of investments to make your future secure and to make you financially independent as well. But for now, let's track the more shorter term perspective, and let's track what's happening with the market. We're definitely feeling the rumble a little bit, and Kunal is back in the studios with us. Kunal, you know, it's getting a little slippery out there. We've twice up until now breached the 19,300 mark, again tried to recover, but it's looking very shaky and unstable.
Yeah, but I think this time around it's not as panicky as, I think, if I can use that word, as compared to last time when we were at sub 19,300 mark, because that was a point where most of the stocks had seen first round of sharp selling. Then, you know, portfolios got adjusted, risk, got tapered off to a larger extent. So what we are seeing is a retest of the previous lows. The Nifty is back at the 50-day moving average, and I would sense that that 90,250 mark, from where we've bounced off so far on an intraday basis for the index, is a very important 50-day moving average support, which I believe should hold up for the index at least over the next couple of days. So I would expect that the index would now get into a bit of a range over here, maybe 9,300 acting as a pivot for the index. The weaker part for the markets, or the weakness, actually lies in the banking index, and I think that's the more critical index to watch out for, because the more the weakness the bank Nifty shows, say in the next couple of days, the more is the chance that we would drift significantly lower on the indices. So I think in terms of sectoral indices or in terms of the major indices, bank Nifty is the one which could lead the sell-off if it happens on the index.
Okay. Nuresh, what is the importance of today's price action? I mean, the fact that we are talking about 19,500, 19,400, that is decisively down now.
So the first fact is that the recent low, which was around 19,250, 300, that has been broken. Whether we close below that would be the concern. On the Bank Nifty, we broke that on Friday. But overall, the fact remains the same. We went from 16,800 to 20,000 without a meaningful correction. The last major support is at 18,800, 850 mark, which is where we had the previous all-time highs. So this is a band where we'll be consolidating, say 19,300, maybe shift to 18,800, 900 if we sustain below 19,300. But this is just a part of a corrective move, and one should be looking out for reversal signals. So for now at 19,300, you take a call that we could reverse from here, keep a 60, 80 pointer stop loss at 19,300, buy with a stop loss at 19,220 and wait for a bounce. And the bounce could again go back towards 19,550 levels. If this does not play out, then you wait again if it sustains below 19,300 levels. But overall, corrective move across the board. We have some bit of overheatedness in the small cap index, which has also seen some bit of a correction. But this is what will happen. There will be shakeouts in such a trending move.
So Kunal, it could be again, Bank Nifty is weaker than Nifty.
Yeah.
It's getting more and more pronounced now. Would you go short on the Bank Nifty?
Yeah, I think you short the Bank Nifty, short the weaker index over here. Unless it shows signs of recovery or any kind of an intraday spike.
Weaker index. I never heard. I never thought I'd
No,
hear
I
this
think
in 2023.
since the last 1 month, the Bank Nifty is underperforming. Since the last 1 month. In fact, private sector banks are one of the major reasons why the Bank Nifty has been a big underperformer. Even in this list of comebacks for the banking names, ICICI Bank struggled at the 1,000 mark. I think it's now back to 950 levels. HDFC Bank had its own share of struggles post that. The news flow and the event which had happened for the stock, and Kotak Bank had its own share of underperformance, Axis Bank. So most of the private sector banking stocks have actually underperformed, and none of them could be able to sustain the breakouts. That's one of the major reasons why the Bank Nifty is underperforming.
I look at the setting this way. What else could go right for the Bank Nifty? I don't know. Everything's worked for them. What else could go wrong for IT? Nothing more which we can think of, because the AI disruption, US regional banks, everything has gone down. Stocks have been downgraded, underperformance has come. What is next for FMCG? We don't know. So that becomes a sector you want to avoid. Auto, everything that could go right has gone right. So there is nothing in the sector excepting IT where you could say that the rate of the change in the short term could be constructive. Pharma is one space where everything is going right. So that's one space today also in today's market sell-off or carnage or decline. Lupin, Biocon, what JX was saying, things are moving up. So for banks, what else could go right? For IT, what else could go wrong? For pharma, everything is going right. And for FMCG, nothing is going.
Yeah, and so is the case for media as well. Z, especially after that nod for the merger, that's seeing some more follow through, 1.7% higher, and movies are clearly back. Look at what PVR Inox is doing. That's your top mover today. Almost a 2.5% gain is what that stock is sitting on. Tell you what, we'll take a very quick break on that note. When we come back, more discussions lined up on the other side.